All right, and how liabilities play a role in that. So, we have a couple different liabilities that we're going to talk about in this chapter. So, liabilities, we know, we've talked about liabilities from day one, right? What are our two main liabilities?
Short-term and long-term.
Short-term and long-term. So, specifically, what are those two liabilities called?
Accounts payable and
Notes payable, right. Now, notes payable can be short-term, but notes payable typically are long-term. And what's the definition of a notes payable?
it's a
long-term
formal contract.
A formal agreement. It doesn't actually have to be legal, but a formal agreement to pay, doesn't have to be long-term, right? It's a formal agreement to pay, usually with interest starting immediately. Accounts payable is when you wheel the stuff into a store, they bill you and you pay within 30 days, and there's usually no interest on that item, right?
I have a question. So short-term note payable, there is interest?
Yes. Yep. Notes payable is going to be interest because it's a formal agreement to pay with interest immediately. All right. So we've talked about this. We don't need to continue on. And then we know about how they hit the financial statements because we've been doing liabilities and stockholders' equity since Chapter 3. All right. Accounts payable. We have accrued liabilities, which we talked about. The book refers to that as anything that's a short-term liability that's not accounts payable. I'm not a big fan of that, all right, but they kind of jump everything into that. A lot of times that's going to be salaries payable, utilities payable, if they break out utilities payable into telephone payable and electric payable, that type of thing. It's all going to fly into that one item, all right. That's an author specific, but everybody kind of has their own liabilities. That's what accrued liabilities is here. Then you have notes payable, and then you have something called current portion of long-term debt. I've mentioned this several times before, but we haven't really got into it. Every long-term note has a short-term portion. So think about a mortgage. Mortgages are typically 15 or 30 years long. Okay, you get to pick which one you want to have. So if you have a 30-year mortgage, that means, and you got it starting today, that means part of that mortgage is short-term because it's due in the next year. So of my 30-year mortgage, 1 year of that is always going to be a short-term notes payable, and then the 29 years is long-term. So of a note payable, part of it is always going to be short-term because you owe it in the next year. And every year I have my mortgage, the long-term is going to go down a year, but I'm always going to have a year that's current because I owe it every month. So I just paid my November mortgage. I owe December through next November, and that's my current portion of the mortgage. And then I owe another 25 years. I moved 5 years ago. All right? So 1 year's current, 24 years still to go. And then once I get that next year done, 1 year current, 23 years left to go. I'm not counting or anything. All right? So you just kind of go through that always with 1 year. And the only time I don't have a long-term note is in 24 years when I pay my house off, which I won't be in that house by then. But that's when it's gone. So every long-term note has a current portion of that debt because you're always going to owe something next month. You have a question?
Yeah, current portion means the debt we already paid.
No, it means the debt you have to pay in the next year. So this current portion of long-term debt right here is the next year of that note payable. All right, so let's look at our typical types of liabilities. Okay, now we know some of them. We've already talked about them. Right? And we already talked about how we have the cash equivalent and what's going to increase and decrease. So that's not new. And neither is accounts payable. For some of this, the chapters kind of do a quick little review, and you're going to do some journal entries that you should know like that. For example, you pay off an accounts payable. What's the journal entry?
accounts payable.
Accounts payable cash. All right? That should be nice and easy. You pay off wages payable. You pay your wages. What are you going to do?
Wages payable cash.
Wages payable cash. You incur wages, but you don't pay them.
Deferred.
Accrued.
What's going to be the debit? You incur wages, but you didn't pay them.
Expense.
Wages expense and
Wages payable.
wages payable. All right. All right. So, one part of this that's why I said the last journal entry, wages, is we have payroll, all right? Every company has some type of payroll unless you're completely a sole proprietorship and you don't pay yourself out of a true wage, you just take your withdrawals, which we talked about in applied accounting, when you can just take money out, right? What are you going to say? Distributions, right. So when you're a sole proprietorship, you don't have to pay yourself a wage. You can just take money when you need it. You need to be very careful when you do that, but you can just take money when you need it. So in payroll, there are two types of ways in which you have liabilities. There's something called payroll deductions, and there's something called employer payroll taxes. This is one thing that a lot of people don't realize, especially when they go off on their own as a contractor, all right? So you got to look at what comes out of your paycheck. So if you graduate and you make $50,000 a year, all right, that's your first salary. Is that how much you're taking home?
No.
No. All right, so we're good. We know that, so that's a good start. So if you're making $50,000 a year, what do you think you're actually going to take home?
35 to 40,000.
Okay, so 35 to 40,000. Let's go with the lower part of that. Let's go with the 35, all right? And I'll be honest and tell you, I can't, with the new tax laws, I can't even tell you, and I do taxes. I got a whole bunch of classes that I'm attending right now to tell you what that number is really going to be next year. But we're going to go with the 35 because I think 40 is a little high, okay? Even with the current tax laws. What comes out of here that gets you down to here? What kind of income tax?
State and federal taxes.
State and federal. So FIT is federal income tax. Actually, I'm going to just put it under FIT, federal income tax. SIT, state income tax. Insurance, right. So then down here we have insurance.
Medicare.
Medicare.
All right.
Social
We're going to put those. FICA is actually Social Security and Medicare. In case you didn't realize, when you say FICA, you're including both. All right? That's actually Social Security and Medicare combined.
401k.
401ks.
What is that?
401k, that is when you decide that you want to take some of your money before taxes and put it in a retirement plan.
Okay.
What else could we have? There's one more that I would put up here, and then there's several more you could have down here. Garnishments, yep. Those are fun. All right. What does she mean by garnishments? Gosh, yeah. Debts you owe that the state is going to take out of your paycheck because you have no choice. Child support, back taxes, could be student loan debt also. Those are things that could automatically come out of your paycheck. You have no choice. Alimony could also come out of there.
They can automatically take student loans out of your paycheck?
No, they do not.
Oh.
Until you aren't paying them. Then they could.
Okay.
There's one more up here. What isn't listed here that in St. Louis, specifically in the city of St. Louis, you could have to pay?
City taxes.
City taxes. We call those local income tax. All right? It depends on where you live. If you live in the city of St. Louis, even if you work in the county, you have to pay it. Or if you live in the county and work in the city, you have to pay it. And a lot of people miss that one. All right? My sister-in-law was one. She lived in the city and worked in the county. And yes, her employer should get that, but they didn't. And then after she got married with my brother, all of a sudden she gives me this thing. She owes $2,500 for like 3 years. Now she didn't end up owing that. They had moved to the county, but she owed half of it. And she goes, "What do I do?" I'm like, "Well, you have to pay half of it." You know, so a lot of times people that live in the city and work in the county miss the fact that they still have to pay it. It takes the city a while to catch up, but they figure it out. So you do have to pay the local income tax. Anything else for the bottom that you can think of? There's things like health care, which is not insurance. This is where you can take out for things like it can be a flexible spending account, or it can be to pay for your health insurance, that's what that is. That's the difference between the two.
Are you going to test us on these things?
Well, I'll show you what exactly, but this is part of Remember, everything I test on isn't necessarily everything you should know, too. Remember? Okay. All right, anything else you can think of? All right, another one, savings. These right here are what we call voluntary, and these are called mandatory.
Garnishments aren't.
Well,
mandatory?
yes, you're correct.
Okay.
Garnishments aren't voluntary from the standpoint that we get a choice, but these are, everybody has to pay these. Everyone does not have to pay these. Okay? You're making yourself pay that one.
Okay.
Right. So the top ones are something that comes out of everybody's paycheck, no matter what, as long as local is something that is in that area. All right. So those are going to reduce your paycheck no matter what, and that is going to get you down to this. Does anybody know what this is called?
Gross income, net income.
This is net pay. That is gross pay. All right. So your first job, they're going to tell you your salary, and that is going to be your gross pay. That means that's the most you're going to make. So don't get too excited, right? Then you're going to take it down to what is called your net pay. Your net pay is going to be what you're then going to divide by the number of pay periods you have, whether it's 12, like we have here, 24, whatever you're going to have. And that's what's shown on the slide here, the net pay, and these are the various deductions that they're having taken out. Right. Now, obviously federal income tax and state income tax are based on what you have in the state you live. What about FICA? Do those change?
I think it does. If you claim on like a tax form if you're like single or married or.
That's this one.
Okay.
All right, federal income tax is you can choose what comes out of your paycheck, but at the end of the year, it's based on it's based on who you are, if you're married, and how many kids you have. So you can choose to take nothing out. You can choose to take a whole bunch out. But at the end of the year, when you file your taxes, you're going to owe based on your married status and how many kids you have. So you can choose to not take anything out, but then you're going to owe a lot of money at the end of the year. The perfect world scenario is you file what's called your W-4, so that at the end of the year, you owe nothing at all. That's the best case scenario, right? They shouldn't hold your money and you don't want to owe them anything. Doesn't usually work like that. Best case scenario. Social Security is the same for everybody. Whoops. It's 6.2%. Everybody pays 6.2%
Of your paycheck.
of your paycheck.
It's not optional.
It's not optional. Medicare is 1.45%. That's not optional either. All right? The only difference between Medicare and Social Security, and I am completely drawing a blank in my head right now, is Medicare, Social Security stops. This might be last year's number. I'm drawing a blank. At 118.5, I think. Meaning, and I'm going to get the number before, but I'm drawing a blank in my head right now. Meaning, once you make $118,500, you no longer pay. So, if you make $120,000 a year, you pay 6.2 till you hit 118.5, and that other $1,500 does not pay Medicare. I mean, not Social Security. Medicare, you pay forever and ever. All right. Now, without getting into all the stuff behind it, there's a lot of issues with Social Security. You guys have heard it. You've heard whether or not you're going to have it when you get older. I heard it. They don't know if I'm going to have it when I get older, which actually I won't have it because I don't get Social Security anymore. But one of the things with Social Security that hasn't kept up with the times is my mom and dad explained to me that when they were younger, before they had kids, there used to be something called Cap Day. And Cap Day happened like in June. And that's when you reached the Social Security cap and you no longer had to pay in. And the cap was like $4,000. And somebody that had a good, decent job, my dad, would reach that in June. And his salary might have been $16,000 to $20,000, but he reached that. And the normal person would reach the cap. The average person, the majority of above average people, do not reach this cap anymore. So there's a lot of debate over if the normal person isn't hitting the cap, should there be a cap?
How do they base that number? How do they figure that number?
I can't give you a rationale for it anymore. It does go up every year. but I can't give you a rationale. There'd be a lot of deep discussions behind it, but I can't give you a rationale for it.
So some foreign, I don't know. Why do you guys pay that? The Social Security? Is it for your retirement?
It's for your retirement. So once you hit, you got a stacked number. 65, you can collect a partial. 67, you can collect more, and at 70, you can collect all of it.
So why would you? There was another one in the bottom for that.
401k.
401k is your own money that you're putting aside.
So why
This
would
is
you
your
do
money. This is your money that the government is mandating comes out. Now here's the other side of this. That employer payroll taxes, your employer also puts in 6.2%
For you.
for you and 1.45. So at the end of the year, you are getting 12.4 and 2.9% of your salary put into Social Security and 2.9 put into Medicare. All right? That is what is supposed to be there to supplement, that was the whole purpose of Social Security, to supplement your retirement. It wasn't originally designed for you to live your life, but to supplement your retirement.
There's no way to get out of paying Social Security.
Well, if you're a public employee, there is. I don't pay into Social Security, but I won't get Social Security.
As a government worker?
But I also have to put in, is it 14.5 still? I think it's,
I always think of it as 15.
I was going to say, I think it's higher.
14.5.
We are forced to put in 14.5% of our salary, even higher. But they match it, and so right now it's 28% of our salary is being saved, but we are forced to put in 14.5. I don't mind that, but think about the fact that if you're a public school teacher, this is the debate on our end, who starts off making a lower salary and 14.5 of their salary is going into savings. That's a lot harder than 6.2. Now, most people, when you're starting off, you don't notice that. It's 6.2. You've all been paying 6.2 on any job you've had. I can't speak on the foreign side. I actually don't know that. I would think it comes out, but I honestly don't know. Look at a paycheck.
Yeah, we do, but
Okay.
a bit differently. But I wonder why would you guys do that and also 401k at the same time?
Well, some companies do. Some companies will actually match your 401k, depending on the company. So if you put in 4% of your salary in a 401k, some companies will match that. But that's the company, not the government. This is a government.
Security might not be enough.
Right. Well, Social Security is not meant to be enough. Social Security is meant to supplement.
So 401k is good.
401k is very good. All right, especially if your company matches it, because then that's extra money going in. So when you get a job, if you have a company that matches it, you're actually losing money by not putting your money into it. If you put 4% in and your company matches up a percentage of that 4%, then you really need to put that 4% in. All right, so let's move on. So there it talks about, oh, I forgot charity up there. A lot of people, if you donate through your paycheck, charity, it's 100% tax-free. But if you give to charity outside of your paycheck, you get a charity deduction. And one of the new things with the new tax law is itemized deductions are going to be much harder. So therefore, getting a charity deduction on your itemized deduction might not be there. But if you give through your payroll, you're giving 100% tax-free. So it's things like United Way, which most companies do something, that's a lot easier to give tax-free. All right, so they give an example with numbers, kind of how we got from our 50 down to our 35. They do it on an actual paycheck. So let's look at how this is going to look in a journal entry. We always come down to our journal entries, right? All right, that's how we are from the financial accounting. This is actually you guys. All right, so remember how I told you, all this reflects back to you. There's a reason that you guys need to learn this, both from a school standpoint, going into the business world, and both from a personal standpoint. There's a lot of this you guys didn't know, all right, but it affects your paychecks. This is the journal entry you need to know from the business world, all right? So the journal entry is going to look like this. You have salary and wages expense. That's our same debit we've had all semester that just said wages expense. Same thing. The only difference with this is now we have three payables. We have income tax payable, because that's this right here. All right? They don't turn around and pay the government the taxes immediately. All right? We have FICA payable. We don't pay Social Security and Medicare immediately. They have United Way payable because they took out some charity, but every one of these listed here would be a payable. And then you have cash because you paid your payroll. When these payables become cash just depends on when they make the pay. So for example, United Way, that might be a monthly check they send to United Way. And if you're paid weekly, that means it's going to stay United Way payable for the month, and then at the end of the month they pay it. The taxes payable, that's going to depend on the size of the company. A big company like AT&T probably will pay their federal taxes within 48 hours. A smaller company, like the example I give where my brother works, where they have 30 to 40 employees, they probably pay every couple weeks. So it depends on the size of the company, how often that they have to make those payables.
End of the year entry.
This is a salary. So this is probably weekly or biweekly, depending on how often you're paid. So here at the college, we have multiple levels. So staff is paid bi-weekly, I think, yeah. And then I've told you guys we are paid monthly. So our monthly, this would happen once a month. And then income tax payable is probably paid within a week for us. Staff is every other week. They probably pay all taxes at the same time.
So at the end of the month, your pay account will decrease?
At the end of the month, the accounts payable would probably all be decreased. Yep. The smaller the company, the longer the payables are probably going to stay there. Because they're not going to be very big. They're probably going to wait till that United Way paycheck is big enough to send them a check. If it's a small company and it's a small check, they're probably going to wait until it accumulates to be a little bit bigger.
So this is the company standpoint?
This is the company paying you. This is how much it costs them from a standpoint of this is what they offered you guys as each a $50,000 paycheck. All of you guys add up to $600,000. This is your pay.
Okay.
All of this right here comes out of your pay, and they're paying this on your behalf. All right? None of this is something they owe. They pay their taxes in April or whenever their tax year ends. Because remember, their tax year doesn't have to be December 31st.
Why are they recording it when they are our salary?
Because they take it out of our check and they pay it for us. Because remember, we're a pay-as-you-go country, so the government wants their taxes as we earn it. So they take it out of our paycheck and they pay it. If we're a contractor, we're responsible for paying it ourselves. But as an employee, the company pays those things for us.
And they record it in their journal.
Well, they have to. They're holding our money.
And the money came out from them.
Yeah.
Yes.
They're paying us, they're holding our money, and then they will in turn pay that for us. If they gave it all to us, that would be called a 1099, all right? And that would not, we would no longer be an employee. They'd just give us our money and we'd have to pay it ourselves. That would be a mess if everybody was a contractor. All right, now that's them paying us. The other side of it is what do they have to pay to employ us? There's a tax on them to employ us, and that's this. All right? For them to employ us, they have to pay Medicare, and they have to pay Social Security. For every employee, they have to pay that. In addition, in some states, they have to pay unemployment tax. Okay? And we call that FUTA and SUTA. All right? Now, in some states, employees have to pay that, but not in Missouri. All right? We're lucky. In some states, employees have to pay unemployment tax as well. But Missouri, you don't have to do that. How much a company has to pay for FUTA and SUTA depends on how often they lay off employees. The more often you lay people off, the higher your state unemployment tax is. The federal unemployment tax is very low. It's usually around 0.7, 0.6 to 0.7. That's just for administration. The state unemployment tax is what is the higher rate based on your layoff rate. Because that's who actually pays unemployment, is the state. All right, so this is a different journal entry. It's very short. And notice the first part of it is payroll tax expense. This is the tax on having a payroll. The other one was salary and wages expense. That's our wages, me and you. They're paying our wages, salary and wages expense. This is a tax on having payroll. All right, so the fact that we have a payroll is going to cost us 6.2 and 1.45 FICA tax payable, and then unemployment tax payable. There's no cash until we pay those payables. And when do you think they're going to do the FICA tax payable?
Once a year?
No, they're going to do it when they pay our FICA tax payable. They're going to combine and make one tax, and they're not going to do it once a year. Again, it's going to be based on the size of the company, but probably closer to once a month. Those are the only 2 journal entries with payroll. You got your salary and wages, which is the payment for us, and then you got the payroll tax expense, which is the tax that the company has for employing us. The big thing you want to remember is FICA is double. 6.2 that we pay and 6.2 that the company pays. 1.45 that we pay, 1.45. So if you decide to be a contractor and go out on your own, who pays the other 6.2 and 1.45? You do. So you come up with that hourly rate that you think you need to charge to come up with your same pay. It is not just your salary divided by hours, because now you have to pay this other side.
Wait, so you're double taxed?
Well, you're not double taxed, but you're now your own boss. So you now have to be the employee and the boss.
So we will learn this in taxation class.
Kind of. In taxation, you're learning about taxes from the standpoint of what's paid at the end. So you're going to learn about federal income tax. You don't learn about payroll. Payroll tax is taught in 213. Okay, that's a different class. All right. Taxable income as a whole is anywhere, and this is an old slide that next semester will no longer even probably be valid, but right now it's 15 to 35%. Well, you need to know that there's a tax rate on federal income tax. And then obviously you cannot figure that out until you know how much, but General Mills as a corporation has nothing to do with payroll. General Mills taxes are going to be on their income, right? Not their payroll. They're going to pay their taxes at the end of the year, and they're going to be taxed at a rate based on if they're up in the millions, they're going to probably be at the highest tax rate. And we've done this journal entry all year. That's the adjusting entry that we can't do until we've done all the other adjusting entries. All right, so let's stop there and look at a problem.